Shopify just released their latest quarterly figures and it was another great quarter by the company. And so at the time of making this video, the stock is up 17%. The stock is back up over $63. Now, yes, it's true that when you were looking at this company, even before the earnings report, you could have said, oh, this is a very, very expensive company. Forward PE, 52.5 times, EV to sales, 7.4 times, EV to EBITDA, 50.3 times, or forward looking. And yes, that is very true. That is also why year to date the stock was down 30%. Year over year, stock was down 6.4%. Of course, now with the pre-market action, it's going to be green year over year. Year to date, we're still going to be red-ish. But overall, like I said previously, it's not always very smart to just look at those metrics and say, oh, it's an expensive company. No. First of all, it has always been expensive. Now, I know that's not an excuse. Oh, it's always been expensive, so now it's less expensive, so it's a buy. No, you're right, that's not an excuse. But when a stock becomes less expensive, when the business becomes more profitable, usually that's a good thing. Now, for Shopify specifically, right now, just looking at PE does not make much sense. I'd rather look at free cash flow, and free cash flow is growing nicely. Free cash flow margins has gone from 6% to now 16% in just a year. And of course, they're not done yet, but we'll discuss that further in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe. If not, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's first start with a couple of comments here. So our Q2 results make it clear. Shopify is rapidly strengthening its position as a leading enabler of global commerce and entrepreneurship. More and more merchants across the world are putting their trust in Shopify's unified commerce operating system to fuel growth and simplify complex operations. We're fully committed to executing our growth strategies and delivering immense value to our merchants for years to come. We are proud to report another quarter of robust financial performance. We drove strong growth in GMV, revenue, and gross profit, all amidst a mixed consumer spend environment, continued to take share and concurrently expanded our free cash flow margin. We delivered across every metric. Our results underscore our commitment to providing exceptional value to our merchants through focused operating execution and efficiency. As a high-growth global technology leader in commerce, we remain committed to leveraging our core strength and investing in opportunities to achieve sustainable growth and long-term profitability. Which is why we're seeing these numbers. GMV increased 22% to $67.2 billion. Revenue is up 21%. Merchant Solutions revenue is up 19%, driven primarily by the growth of GMV and continued penetration of Shopify payments. GPV, or gross payment volume, grew to $41.1 billion, representing 61% of GMV processed in the quarter versus 58%. Gross profit dollars grew 25% to $1 billion, with gross margin for the quarter at 51.1% compared to 49.3%, driven primarily by the lack of dilutive impact by the logistics business and changes in pricing plans, partially offset by continued growth of payments. Then, free cash flow, that was $333 million compared to free cash flow of just $97 million same quarter last year. And like I said, free cash flow margin 16% now compared to 6% 12 months ago. As for cash and marketable securities, that was at $5 billion, and they had a net cash position of $4.1 billion after consideration of their outstanding convertible notes. Now, if we look at the two segments of revenue, so subscription solutions and merchant solutions, subscription solutions grew 27% while merchants increased 19%, and cost of revenues, same thing as previous quarters, they're growing revenues more than the cost, which is why you're seeing gross profit grow quite nicely. So subscription solutions, cost of revenues up 14%, merchant solutions up 16%, and so gross profit is now up 25% year over year. As for operating expenses, you can see that GAAP operating expenses as a percentage of revenue has gone from 146% same quarter last year to now just 39%, which is why you're seeing income from operations go from a negative $1.6 billion to now $241 million in income for operation and not a loss. This is called operational efficiency, and it's still early days. As for the third quarter, they expect revenue to grow at low to mid-20s% rate on a year-over-year basis, gross margin to be higher by approximately 50 basis points compared to Q2, GAAP operating expense as a percentage of revenue to be 41 to 42%, so a bit higher than what we are right now, free cash flow margin to be similar to Q2, and they continue to expect to deliver double-digit free cash flow margin for the rest of the year. And so overall, if we look at what Consensus Gurus has told us, well, again, a beat across the board for this quarter, especially from a profitability standpoint. I mean, if you look at operating margin, the beat here is by 285 basis points, EPS beat by 30%, free cash flow beat by 33.2%, GMV small beat 2.3%, MRR monthly recurring revenue 7.2%. As for Q3, only one miss there, and that's for gross margin, a miss of just 30 basis points. All the rest, revenue beat by 1.8%, operating expenses as a percentage of revenue beat by 294 basis points, stock compensation 4%, which is lower, which is better, and free cash flow margin beat by 233 basis points. So overall, very, very strong quarter and good outlook as well. Not a cheap stock, but a great company. And so right now, looking at the graph, of course, in recent weeks, you had a huge drawdown for Shopify and actually for most of the stocks on the stock market. It would seem that for this week, we're going to have quite a big green one, which right now would put it at the 50-day moving average that's just above $63. The 200-day one sits at $66.21, which was previously a resistance point, because as you can see here, for a couple of weeks, the stock did try to go over the 200-day moving average, did not succeed, and then we went all the way back down to a point we've been back here in October of 2023. Now, RSI, yes, is low, but on the weekly, it's not like it's close to being oversold. If we look at the daily was oversold, of course, at the start of this week, just like plenty of other stocks, but then we've seen a rebound in the last day or two. And if we zoomed out, we can see that we dipped all the way back under $50, which was also when we gapped up back here in November of 2023. So that gap is basically filled. Now, you know what they say about gaps. Not all gaps get filled, but most of them do. This is another case of most of them do. So overall, good quarter, solid execution. Like I said, Shopify, fortunately, you will never really get it for cheap. You can get it for less expensive, and I guess that's the best you will get. But you have to look at what the business is doing, and the business is growing, and it's growing in a more profitable way as well. Great leadership, good execution, exactly what you want. Me personally, I don't own Shopify anymore. I made my case a while ago why I went with Amazon, well, fully Amazon, because I had both companies in the portfolio. I chose to just put everything into Amazon. Just made more sense for me personally. Of course, plenty of other people said, oh, look, Amazon is Amazon. Let me put everything in Shopify. That's fine as well. Do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.